10 steps of the accounting cycle recap. 1. Analyze transactions. 2. Journalize transactions. 3. Post to ledger accounts. 4. Prepare a trial balance. 5. Journalize and post adjusting entries. 6. Prepare an adjusted trial balance. 7. Prepare financial statements. 8. Journalize and post closing entries. 9. Prepare a post-closing trial balance. 10. Reverse. Optional step depending on the business. Module 10 focuses primarily on steps 5 to 9. Adjusting entries. Adjusting entries ensure revenues and expenses are recognized in the period they occur. Common types include accrued revenues, revenues earned but not yet received or recorded. Accrued expenses, expenses incurred but not yet paid or recorded. Deferred revenues, unearned. Cash received before revenue is earned. Deferred expenses, prepaid. Cash paid before the expense is incurred. Depreciation, allocation of an asset's cost over its useful life. These entries are made at the end of the period based on the accrual basis of accounting. Second, adjusted trial balance. After adjusting entries are made, they are posted to the ledger. Then, an adjusted trial balance is prepared to verify that total debits still equal total credits. This updated trial balance is the foundation for preparing financial statements. Financial statement preparation. Based on the adjusted trial balance, the following are prepared in order: income statement revenues, expenses, net income or loss, statement of owner's equity or retained earnings, opening capital plus investments plus net income minus withdrawals equals ending capital balance sheet, assets equals liabilities plus owner's equity. These reports provide an overview of the financial health of a business. Closing entries. At the end of the accounting period, temporary accounts, revenues, expenses, and drawings dividends are closed to owner's capital or retained earnings. This resets these accounts for the next period. Steps: close revenue accounts to income summary, close expense accounts to income summary, close income summary to capital, close drawings dividends to capital. Post-closing trial balance. This trial balance only includes permanent accounts, assets, liabilities, owner's capital, or retained earnings. The purpose is to ensure that debits still equal credits and that the ledger is ready for the next accounting cycle. Key takeaways. Adjusting entries ensure that income and expenses match the correct period. The adjusted trial balance is the base for financial statements. Closing entries are essential for resetting temporary accounts. A post-closing trial balance verifies readiness for the next period.